Hello everyone and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be going over my dividend growth portfolio that I'm using through M1 Finance. A lot of you guys that watch my videos, you might not know exactly what my strategy is, what exactly I'm intending to do with each one of these stocks, and every single month I'm going to be showing you guys an update for those of you that are new to my channel, and I'm going to be showing you exactly what I'm going to be changing in my portfolio. Am I going to be adding to these positions? Am I going to be selling some of these? Am I going to be lowering or raising the weights on these positions in my M1 Finance portfolio? And as usual, if you enjoy my content and you like watching my videos, make sure to use this link down below. It's in the description right here. If you paste that into your web browser, you can use my referral link and we can each get $10 in your portfolio and we can help get you started, and I'll make sure to mention you in the video. So in the video, we're going to be going over the yield for my portfolio. We're going to be updating Google Sheets, our dividend trackers, our charts and everything. And then we're also going to be showing dividend raises for Apple. So to get started, let's show the activity for my portfolio. For the month of April, our first month here on YouTube, our first month using this M1 Finance portfolio, we made 3 deposits starting off with $1,500, and then we made 2 deposits for $100, and we made 3 different purchases. We received 1 dividend on the last day of April, and then on May 1st, on Friday, we received 3 dividend payments. In total, since starting the portfolio, we are up $176.85, which is about an 11.23% return. About $173.44 of that has come from market gain, and $3.41 of that have come strictly from dividends. Those of you that watch my channel and know my strategy, this is the dividend growth portfolio. So we're going to be focusing on this number, the earned dividends number. We're not too focused on this market gain. It doesn't matter if it goes up or down. If anything, we almost want it to go down so we can buy these dividend stocks at better valuations. It's good to see it go up, but hey, either way, we're going to be sitting pretty just fine either way. So with these first little payments of dividends coming in, I'll definitely be adding that to the tracker. We'll be going over that in just a minute. But it's good to see our first little dividend payments coming in, and I know it's not starting off with a lot, but this 48 cents, this 55 cents, 62, 34, these are eventually going to turn into $1, and then $2, and then $5, $10, and eventually the deposits are going to start getting great enough from these dividends that it's going to start buying significant portions of shares. So on our dividend income for 2020, to start off the portfolio with the $1,500 we started off with, we made $66.67 in annual income. After making 2 deposits and then having several dividend raises like the Apple one that we'll be going over in just a minute, we raised that to $75.36 in just 1 month. So about $10 in annual income was raised in just the first month of this portfolio through the YouTube channel, and the portfolio went up $373.32. So for the month of April, we only were able to receive 1 dividend because we just started, so we had to wait for stocks to claim those dividends and then actually send us the check. So we only received 1 of 48 cents. And so far for the month of May of just 1 day, we've already received $1.51, and that number will of course be going up, and we have a lot of stock claiming their dividend. So as you can see here, for the 30 companies I have, starting with Broadcom all the way down to Verizon, these are all the stocks that I own, and this is what they pay me annually. And as you can see, the total right there, as I mentioned, up to $75.36. That's what they make me, and this is what we'll be adding on in the coming weeks. I did just increase Apple, which Apple is, by the way, the lowest paying stock in my portfolio. It only pays me about 43 cents a year, which I know is not very big, but I'll be explaining why I own Apple and my intentions behind it. Apple did just raise their dividend. Apple's board of directors have declared a cash dividend of 82 cents per share of the company's common stock, an increase of about 6%. The dividend is payable on May 14, 2020 to shareholders of record as of the close of business on May 11, 2020. The board of directors has also authorized an increase of $50 billion to the existing share repurchase program. So that's the one reason I wanted to show this article. I want to be updating you guys on what the increase of the dividend was. Just so you know, it doesn't say here it was previously 77 cents, so that's being raised up to 82, and $50 billion of additional existing share repurchase program. So this is exactly why I own Apple, because the potential for the share price gains are massive. So now in the portfolio as of today, in the last couple of weeks, we have seen some pretty significant share price gains. The market has started to recover quite a bit. We are still significantly lower than we were just a couple months ago, but still, we are still pretty low, and we have been recovering quite nicely. As you can see here over the 5-year chart, this portfolio has performed about 41.7%, not factoring in dividend reinvestments, and it has started to recover some, but we still do have a long way to go, and who knows if we'll be seeing another test at this lows here. So our portfolio right now does yield 4.03%, It is good to see that dividend yield back over 4%. When it gets over 4%, it's really attractive, and usually in a bull market, this floats around 3%. But now when these stocks are still down significantly, we're getting it over 4. And if we get a big dip back to the bottom, we'll probably be well above 4, maybe even 4.5. So I'll definitely be rooting for another market downturn, and I'll be purchasing shares a lot more aggressively than I have starting off this first month. It seems like the moment after I bought these shares, they immediately just started going up, and I'm buying these stocks much higher than it was previously when I first started off the portfolio. Some of the biggest gainers in the portfolio still Discover Financial Services. We are still up over 40% with the significant red day we had on Friday. Friday was a very red day with only one stock in the green. Whirlpool beat their earnings. 29 of the 30 I owned went down significantly, but overall for the past month that we've owned this portfolio, many of the stocks are still doing very well. Of the 30 that I own, 29 of them are in the green. The only one that we have in the red is Caterpillar. Caterpillar has been struggling quite a bit. This is a dividend aristocrat, and I love this company. But jumping in one by one, we're going to be going through these. Broadcom. Broadcom is the #1 stock in my portfolio, and they make up about 8% of my portfolio. They are an excellent dividend company. They have excellent dividend growth. They are a tech company. They are a semiconductor company. They've raised their dividend from 40 cents all the way up to $3.25 over the last 5 years. They've over doubled their stock price in the last 5 years. One thing that I really like about Broadcom, and with each of these 30 stocks, I'm just going to be going over briefly, just 30 seconds to about a minute through each one so we can fly through these so this video isn't 45 minutes or an hour long. Something I wanted to remind you guys about Broadcom, just about 3 or 4 months ago before the recession hit, they just extended their partnership with Apple to last until 2023 with their microchips, and that will make them an additional $15 billion in revenue on top of what they already had. So that's excellent there to extend their partnership with Apple, and they'll be bringing in more revenue. I absolutely love this company. It's the #1 stock in my portfolio, and I'll be looking at adding shares over the next month. So the next stock we have is Realty Income. This is one stock that a lot of people have been scrutinizing a lot, and their stock price has performed very poorly since the recession hit. This is a monthly paying dividend stock. It's the only one we have in the portfolio. 5 years ago, they paid 19 cents a month, and now they're up to 23.3 cents a month. They have a current dividend yield of 5.4%, so about 5.5%, and this is a real estate investment trust, or a REIT. I've made several videos on Realty Income. Make sure to look at some of my others where I dive deep into Realty Income, why I think it is such a successful, amazing company. Basically, Realty Income, what it is, for all the major stores out there like Home Depot and Walgreens and 7-Eleven, they own the physical properties. They own the real estate behind them, and they get rents from their tenants, and they pay 90% of their revenues out to shareholders. So it is probably the best well-run REIT in the stock market. So I absolutely love Realty Income, and I will be adding shares this coming month. Visa. So Visa is a stock. They do pay their dividend in about a week or so, I believe. This is the lowest yielding stock in the portfolio with only 0.68% yield. That is by far the lowest. I've been very, very bullish on Visa for a long time. Basically, to give a headliner here for why I think Visa is going to be astronomically higher than it is today, 5-10 years from now, 85% of transactions are still done in cash worldwide. So I know so many people in America love to use credit cards, and they're not going away from them anytime soon. And even though we are still growing in America, the key here is the foreign markets, the international markets. So many other countries that are developing countries have not got any kind of credit card terminals, and they're not used to using credit cards. So Visa and MasterCard are pushing towards getting more of those people using credit cards so they can get those exchange fees. Their dividend growth is massive, and this is one of the main reasons why I own Visa. Now, I think Visa has massive potential for share price gains over the next coming years, but they also have massive dividend growth. So they went from 12 cents up to 30 cents over the last 5 years. So about a 2.5 times over the last 5 years, which is pretty substantial. And I think Visa, it's really one of those stocks in this portfolio that I think just has almost no downside. I can't see a scenario where the billions of Visa users just stop using their credit cards and they stop growing. Visa is a high growth company, and I don't think they're going to slow down anytime soon. The next stock was one of the first stocks in the portfolio we had raised their dividend in the month of April. They just raised their dividend from 62 cents up to 64 cents, and they've raised it from 54 and now up to 64 over the last 5 years. This is a very safe, stable, conservative investment. They have about a 4.71% yield, on the verge of a 5% yield. You can read the description here. You can pause if you'd like to read that. Basically what they do is they distribute electricity and natural gas to millions of customers, and they're just one of the largest utility companies in the world. People are always going to need electricity, and that is not going to soften in demand regardless of what recession hits. So electricity companies are very safe and stable. They're regulated by the government, and the Southern Company is a perfect example of that. Wells Fargo is a little bit funny because compared to the other banks out there, like your large JP Morgans and Bank of America, its yield is significantly higher than most banks out there. I am really starting to get on the verge as to whether or not this dividend yield would be safe. It has went from 31 cents up to 51 cents per quarter. They did just issue another dividend payment to come out in a couple weeks from now. Wells Fargo and Company has had some issues over the last couple years with the recent scandals, and they have cut their stock price by about 50%. At the end of the day, I think this company will always be okay. They're just, honestly, you always hear the term too big to fail with the big banks. I think Wells Fargo is another perfect example of that. I don't think this company would ever go bankrupt or anything like that, but their dividend might be at risk through this recession. I honestly don't know as we go along with this portfolio. We'll see. But with any of these stocks, and this goes for all these stocks I will be keeping almost no matter what in a recession. I will not be selling any of them because I do not want to be selling them at lower valuations. The only way that I'm really going to cut these stocks out from my portfolio is if these stocks cut their dividend. So in a case like with Wells Fargo, that stock has the highest percentage weight in my portfolio that actually has a chance of cutting their dividend. People have scrutinized realty income. They think that people won't be able to pay their rent. I don't think that's going to happen. I think all these top four right here are going to be perfectly fine, along with 3M and McDonald's, Pepsi. But Wells Fargo, I could see potentially having some struggles with their dividend. They have cut their share buybacks, but with all these stocks, the only way I'll really be selling them is if A, we have a situation like Zoom stock, for example. Zoom was a company I do not own, but Zoom, when the recession first hit, Zoom stock exploded. So if that were to happen to one of my companies, where it were to go from $70 a share to double that to 170, then I would obviously consider taking some of those gains and reinvesting it back to my lower valued companies. I don't think that's going to happen with any of these companies that I own because they are so safe and so conservative. But if that were to happen, I would sell them, or if they were to cut their dividend. Who knows if that will happen with Wells Fargo? It is one of the lowest performing stocks in the portfolio. I believe it is actually, yeah, it's the fourth worst performing stock in the portfolio. We're barely in the green, but I am still holding on to it. We'll see if they cut their dividend, and if not, I'll be replacing that with some of the other stocks that I've showed in my portfolio, such as like Honeywell, and I've really been wanting to add like CubeSmart and EXR, and I definitely will be thinking about that stock in the next month, whether or not I'll be adding more shares to it or not. The next stock is the first dividend aristocrat of the group. It is 3M Company. They're actually a dividend king. They've raised their dividend, I believe it's 62 years off the top of my head. This is a conglomerate. They have over 56,000 products. They've raised their dividend from $1.03 up to $1.47 over the last 5 years. This stock had a huge run up and in my opinion got pretty overvalued for a while, and now they're retreating back. If you could see the 10-year chart, it is an absolute straight line up with its little dips here and there. But this company, I was talking about too big to fail, they have so many products. Like 3M is one of the largest manufacturers in the world of face masks, and they have been getting a lot of revenues from that. 3M has so many different products and they're so diversified. I would never have to worry about this company ever cutting its dividend. Like I said, I think it's 62 years of consecutive dividend raises. The management and the CEO obviously knows that they're focused on the dividends, and its shareholders are as well, and I don't expect that stock to ever cut its dividend, so I will definitely be buying more shares of 3M while its dividend yield is about 4%. The next stock in the portfolio is McDonald's, another dividend aristocrat. McDonald's is a company that I'm sure you all know and love very well. They are a fast food chain, primarily focusing on hamburgers and fries. They went from 85 cents a share each quarter up to $1.25 each quarter. I do think we'll be getting a dividend payment in a couple weeks, I believe, from McDonald's. They'll be paying out their dividends. They have a dividend yield of about 2.74%, and I'm not really going to explain this. You guys know exactly what McDonald's is, what their business model is. Their revenues are down quite significantly with everybody staying home and eating in with the shutdown taking place, but I think once we get opened back up, I think this dividend yield is safe, and I'll definitely be adding more shares of McDonald's to my portfolio. Next on the list is another dividend aristocrat. I think it's 13 of the 30 stocks are dividend aristocrats. PepsiCo is another one as well. PepsiCo and Coca-Cola do like to get compared a lot because they do have such similar business models. But the reason why I like PepsiCo over Coca-Cola is one, I just strictly like their valuation and their management team a little bit better. I like that PepsiCo has both food and drink in their portfolio of products. PepsiCo, I am a huge consumer of. I love some of their brands as mentioned down here, such as like Mountain Dew, Doritos. I love all those brands. They went from 70 cents a quarter all the way up to 96 cents a quarter in the last 5 years. So good dividend growth. This is a very safe, stable dividend company, and they're constantly looking at expanding their brands, such as like recently in the last few years, they've made partnership with Starbucks for packaging their lattes. You'll usually see in gas stations like their cold lattes and frappuccinos and stuff like that. PepsiCo is the one who packages and distributes those. PepsiCo also recently, about right around the time we started this YouTube channel, about a month and a half ago, they did just buy Rockstar Energy. The energy drink section and also the sparkling water section for the beverage industry has been exploding, and Rockstar is the brand that PepsiCo acquired to try to get a good part of that market share. The biggest competitor here is Monster. They do have quite a bit of the market share, but PepsiCo is going to use their massive market share in other beverages, their brand power, and their advertising dollars to help get the market share up for Rockstar and hopefully make some money and grow the company using that brand. The next stock in the portfolio is another dividend aristocrat, which did just raise their dividend about a week or two ago. I covered it on one of my previous videos. IBM just raised their dividend. They went from $1.30 and they just raised it another penny to $1.63 from their previous quarter. This is a dividend aristocrat that is very safe, very stable. They are a tech company that has a dividend yield of over 5%. And just like with Broadcom, most tech companies like your Apples, your Microsoft usually have dividend yields that are 1% or less or 2% or less. It's good to see tech companies that have significant dividend yields and also have a lot of share price potential in the future. I think with Broadcom, the potential for share price gains is a lot more significant than that of IBM. But IBM has a recent change of management with their CEO being changed about 3-4 months ago. And I think IBM has a lot of potential with their recent acquisition of Red Hat. They'll have a lot more potential for new revenue from Red Hat, and they'll be cross-selling their platforms using that. And I'll definitely be adding to my position in IBM in the coming months. So the next stock in the portfolio that we're going to be going over is Discover Financial Services. As you can see here, this is the best performing stock in the portfolio. The valuation for Discover Financial Services is at rock bottom. It's at a 6.4 PE ratio. And just the other day when I originally bought the stock, I believe it was right around $30 a share. It was actually a little under, I think. It might have been like 29. It was at about a 4 PE ratio. So it is trading at rock bottom, almost as if it's priced for bankruptcy. I will say with Discover, the biggest risk here and why it's been hit so hard and why that dividend yield is skyrocketing, why it's went from about 85 or so dollars a share all the way down to 40, 41 where it's at today, is because a lot of people default on their credit card debt and are not able to pay their credit card bills in a time of a recession. Credit card bills skyrocket, people are not able to pay them back, and the person who's left footing that bill is Discover. I would say that's the main risk here with Discover. I don't think that Discover will be cutting their dividend or slashing their dividend. I think with the shutdown ending as soon as it did and it not lasting crazy months into like the summer or anything like that, I do think Discover is going to be able to maintain that dividend. It has went from 28 cents a quarter all the way up to 44 cents a quarter, and they did just issue another dividend payment just the other day, and they'll be paying that out in about 2 weeks, I think. So Discover, I definitely like how well that stock has been performing. I probably won't be buying too much of Discover Financial Services in the next month, probably because it's performed so well. So the M1 Finance pie will probably take me away from buying those shares, but Discover Financial Services I will definitely be holding on to, and I think they will be able to hold their dividend in the next coming months. So the next stock in the portfolio is a very good performer in the portfolio, and it is about to pay their dividend in about a week or so. It is Whirlpool. I think this is a dividend company that a lot of people overlook. It is not very commonly talked about. It does have a $7 billion market cap, so they are in the S&P. They have a PE ratio of 6.1, a very low valuation company. When I was buying it originally on April 3rd, I believe I started this portfolio of 2020, it was even lower than that, much like the Discover Financial Service. I believe it was trading in the 4s. It has a dividend yield of 4.28%. They've raised their dividend from 90 cents up to $1.20. They were actually due for a dividend raise, but they decided to hold off this one quarter to kind of make sure everything's going good. I actually kind of prefer that with everybody holding off. But the thing with Whirlpool here is they make a lot of your basic white appliances for your household, such as dishwashers, refrigerators, washer and dryer, stuff like that. Whirlpool is a need-based company where people are always going to need appliances, even in recessions. If you are able to afford it, it is a necessity to get a washer and dryer. Most people are pretty much going to go out and buy one the moment they need one. They're not going to wait. They're not going to choose to get other things that are unnecessary over washer and dryer and other appliances. So Whirlpool is a company I love, and I think it is a wonderful dividend play that a lot of people overlook. So make sure to give Whirlpool a look if you're considering adding new dividend stocks to your portfolio. Like I mentioned earlier, Mid-America Apartment Communities was one of the companies that we got a dividend in April. It was the only stock that we actually got a dividend from in April. Over the last 5 years, it has raised its dividend from 77 cents a share every quarter up to $1. We got 0.48 shares of this stock starting out our first deposit, so we did get 48 cents worth of dividends. It currently has a dividend yield of 3.65%, and Mid-America Apartment Communities is basically just good old apartment houses. There's not really a whole lot here. Same thing with like Realty Income, where they have tenants pay their rent every month. The same thing here, but instead of stores like 7-Eleven and Home Depot, this is just basic everyday people paying their rent, and you're getting dividends from that. So Mid-America, I'll definitely be adding shares to that in my portfolio over the coming month. And the next is Microsoft. Microsoft is the same play here that I have, much like an Apple. Microsoft is strictly a dividend growth play here and a share price gainer. I think Microsoft, being in the $1 trillion club and the huge share buybacks it has, the massive dividend growth, I think that it has more upside potential for share price gains than Apple does. And the main reason I own Microsoft and Apple, they're very small percentages in my portfolio, but the main reason I own them, if Microsoft does keep up with this massive streak of growth, then I would like to have a little bit of growth in that portfolio. But regardless, they have raised their dividend from 31 cents up to 51 cents, so almost doubling in the last 5 years, and they're due for another dividend raise in about 6 months, and they'll be adding that as well. I think the potential here with the cloud space, like with Azure and a lot of the other amazing brands that Microsoft owns that is in high growth areas, Microsoft is really one of those companies. I mean, they're one of the only AAA they're one of the only companies in the world, Microsoft and J&J being the other one. They're one of the only two companies in the world that have a AAA credit rating for paying back credit. So Microsoft is a wonderful company, and I'll definitely be adding more shares to that in my portfolio in the coming month. So the next stock in the portfolio is Coca-Cola. Coca-Cola, I won't go over this one very long. Just like what we mentioned with Pepsi, they are expanding their brand. I mentioned energy drinks and sparkling water. They did just expand their portfolio of products. They did just add HAA. Aha was their new sparkling water brand they just came out with. It is a very high growth category, and I will be going over to company in the next couple of weeks about a sparkling water. But anyways, Coca-Cola is a very old, safe, reliable company, and no one's going to stop drinking Coke and all its products. They have raised their dividend from 33 cents up to 41 cents over the last 5 years, and I love this company very much, and I'll be adding that to my portfolio in the next month or so. The next stock in the portfolio, once again, another dividend aristocrat just like Coca-Cola, Procter & Gamble. We did just receive a dividend from them as well. They did just raise their dividend a couple weeks ago. They went from 66 cents a share up to 79 cents a share. Like I said, they just raised it. They have went up about 45% over the last 5 years. They have a dividend yield of 2.71%. Procter & Gamble is one of the safest, most oldest companies in the stock market. As you can see here, since its founding in 1837, they have so many different products like shampoos and toilet papers and Gillette deodorant, stuff like that. A lot of just daily, everyday products that everybody uses and takes for granted and don't really think about. So Procter & Gamble is a very safe, stable company that I'll be adding to my portfolio in the next month. The next stock in the portfolio, as I talk about a lot, that a lot of people mention in their videos and a lot of people cover in the stock market, is Waste Management. I absolutely love the company. I love the business model. I wish their yield was a little bit higher. They do have pretty good dividend growth from 39 cents a quarter up to 55 cents a quarter. Waste Management basically takes out your trash. Anytime you dump trash and you see those big green trucks that say think green, think clean, those are Waste Management trucks. They run on natural gas, a lot of them, to help save on bills for crude oil. They're such a safe, stable business model, and everyone is always going to create trash. As far as share price gains, it actually has performed very well, and I think as the population grows, as we produce more and we get more gross, I think Waste Management will be there along for the ride, and I think they'll have huge dividend growth over the coming years. And this is the kind of stock that I could literally see me never selling unless they just got to ridiculous valuations. It does trade at a pretty high valuation, but this is one of those stocks that I could literally see myself owning when I'm 70 and never selling it. But Waste Management is a company I love, and we'll see how that does over the next month. I will be adding more shares to that as well. The next stock is a brand new Dividend Aristocrat in the last year or so, which I said is the only stock in the portfolio that we are down on out of the 30. Caterpillar is a stock that I absolutely love. The dividend growth here from 77 cents up to $1.03 is pretty good. They are currently yielding a little under 4% at 3.72%. Caterpillar is a company I love. If you've ever seen the big bulldozers, excavators, big pieces of equipment for stuff like that, for building things, for construction, Caterpillar is usually the one you're going to see. They're going to have that logo right there on the side of their equipment, those big yellow pieces of equipment. Caterpillar did get a little ahead of itself a couple years ago. Back in early 2018, the stock roared higher from about $93, $94 all the way up to about 170 or so, almost doubled. And I think in the long term they'll be very successful, and I think this company still has a lot of future growth potential and massive share price gains and dividend growth. I absolutely love Caterpillar a lot. The one reason I would say why it's not higher in my portfolio, the one thing keeping me from adding to this to my portfolio, making it like 7-8% of my portfolio, is the fact that it's so sensitive to the economy. A PepsiCo or a Coca-Cola, for example, pretty much has demand that has never softened. Even in the worst of times with the shutdown and everything, people are going to still drink Coke and Pepsi. People are not going to spend a whole lot on new construction and infrastructure and stuff like that with Caterpillar, and I think it is so sensitive to the economy that making it a very, very large position in my portfolio, 7-8%, is a bit of a risk, but I do love this company, and I will be adding more shares to it in the coming months and lowering my cost basis. It's good to say that about one company that's actually down. I wish it would go down lower just so I could add more shares at a cheaper price. Another Dividend Aristocrat here we have is Kimberly-Clark. Toilet paper, paper towels, diapers, you name it. They make it all. Kimberly-Clark has absolutely performed so well in this recession. They pretty much not even went down at all from their peak, maybe $2 or $3. Kimberly-Clark has a dividend yield of about 3.13%. I believe they're about to pay their dividend in about a week or so. Kimberly-Clark is such a safe company, and they pretty much thrive in any environment. If there's any time when we could prove that, this is a perfect time. When you go to Walmart and you see that literally every single roll of toilet paper is sold out to the bone, Kimberly-Clark is one of the companies, the main company actually, that profits from that. So Kimberly-Clark, people are always going to need to wipe. That's not going to change anytime soon, and Kimberly-Clark is the one to benefit from that. As you can see here, some of the brands that they own, Pull-Ups, Kotex, Depend, Kleenex, Cottonelle. They're going to be around for a long time, and I'll be adding more of the shares to my portfolio. The next stock is another Dividend Aristocrat that I mentioned earlier, has a AAA credit rating, which is Johnson & Johnson. This stock actually hit its new all-time high just the other day. It's not very often you get to say that in the middle of a bear market, in the middle of a recession, but it peaked here about $153.99, and then it went up all the way to about $155, $156 just about a week ago. Johnson & Johnson has held up very, very, very well since this recession is taking place. It hit that big dip, and ever since then it's just been a rocket higher, right back to its all-time highs. Over the last 5 years, Johnson & Johnson has raised their dividend from 75 cents, and this is one of the stocks that did just raise their dividend. They do pay me a dividend in about 2 weeks or so. They raised it from 95 cents up to $1.01. Johnson & Johnson is one of the largest healthcare companies in the world. They make things all the way up to surgical equipment, all the way down to Star Wars Band-Aids. This is a company that I love. They have a dividend yield of a little under 3%, and they're such a safe, stable dividend company that have been around forever, and I'll definitely be adding more of them to my portfolio. I love these Dividend Aristocrats, as you can see. I said I think I have about 13. I think I counted once. I think it was 13 of the 30. And Cisco is the stock that's up next. Cisco, it's really one of those companies that I'm really curious as to whether or not they'll be able to hold their dividend. With all the supply chain issues that has been going on, they went from 30 cents all the way up to 45. They did issue a dividend payment. If I had to pick one way or the other, I believe Cisco will be able to hold their dividend if I had to pick one way or the other. They are a Dividend Aristocrat. I don't think that they'll be cutting their dividend unless it is a last resort type deal. I would say this is one of the higher risk stocks for their dividend because they are so sensitive to the situation going on. There's not many situations where the demand for Cisco would just completely plummet overnight, but Cisco, if they do cut their dividend, I probably would cut them from the portfolio and be adding it with some others, but So far, Cisco has held up with their dividend and it has performed very well. It's one of the higher performing stocks in my portfolio. They have a dividend yield of 3.41%, and I'll definitely be adding more shares to them unless I hear of a dividend cut. They have went up about 30+% since I've owned the stock. And speaking of going up about 30+%, we have NextEra Energy Partners. This stock just raised their dividend just the other day and will be receiving a dividend payment in about a month or so. They went from 24 cents a share and it's had pretty substantial dividend growth. And now they pay about 55 cents a share with a new dividend raise, so over double. They have a dividend yield of about 4.5%. They are a $50 stock, and this is a stock that basically provides renewable energy, and they're going to be the leaders in that over the coming years. And I'll definitely be adding. This is a stock that definitely has a long-term perspective on it, I think, over the coming years as we get more and more renewable, clean energy. This will be the main stock to benefit from that, and the share price gains will be massive as long as with the dividend growth. One of the first dividend stocks that we got a payment from in the portfolio, which has performed pretty well, up about 25%, is Foot Locker. Foot Locker just raised their dividend before the recession took place. They did raise it from 38 to 40. Over the last 5 years, they've raised it from 25 cents up to 40 cents, so pretty substantial dividend growth. They are one of the highest yielding dividend stocks in the portfolio. When we bought this stock, I believe it was $19 and something cents when we first started, so it had a dividend yield that was about 8%. They are also the smallest market cap in the portfolio of just $2.5 billion. It's so crazy to think that I own companies that are just $2.5 billion when you have companies like Apple that have literally just issued a share buyback program that could buy this company outright 20 times over, worth $50 billion. So that's pretty crazy to see. They have had some struggles over the last few years. The main reason why I like Foot Locker. This is one of the stocks that I would not like to own for 20, 30, 40 years till I retire. A lot of these stocks that I look have a long-term growth outlook on them. They have a 3-year outlook. They have a 5-year outlook, a 10-year, whatever. Foot Locker is one of those companies that I really just want to buy now during this recession and mostly sell out once we get back into a bull market when the share price recovers. I think strictly from a value standpoint, this company is extremely undervalued. As you can see here, a 5.7 PE ratio. They have a payout ratio that is right around 30%, so the amount of profits that they pay out to shareholders, this dividend should be safe even with the substantial dividend growth and the supply chain issues. Foot Locker is a company that I think will perform very well in regards to share price gains and the massive dividend yield. I absolutely love this stock, and I do plan on owning it for the next couple of years, and we'll be adding shares to that in my portfolio while the shares are low. So Apple was the stock that we mentioned earlier. Apple, as you all know, probably made the cell phone that you're holding right now, that you're probably watching this video through. Apple just added $50 billion to their share repurchase program, and they have their dividend, like I mentioned earlier. They have a 1% dividend yield, which is very, very low. I will say with Apple, I would like to see that they spend more on dividends rather than their share repurchases. But the same thing with Apple, like I mentioned with Microsoft, they have such large potential for share price gains in the coming years that I hope to get some of that. The next stock in the portfolio, we're getting towards the end here, is Home Depot. Home Depot has performed very well. We're up about 22% on the stock so far with starting the portfolio. It has went from about 59 cents a quarter up to $1.50, so that is nearly a triple up. They have a 2.75% dividend yield, and Home Depot is just one of those companies. Very simple business model. You've all been to their retail locations. Home Depot basically deals with home repairs and appliances and stuff like that. Home Depot is a company that I love, and I love it as a consumer as well. I love their stores. Home Depot is a stock that has performed very well on both share price gains and dividend growth. I was really stuck between Home Depot and Lowe's. I didn't want to add both. I wanted to add one or the other, and I like Home Depot better than Lowe's. Not that I wouldn't consider adding Lowe's, but I like Home Depot better. So that is a stock that I'll be adding over the next month. And speaking of banks, from the beginning of the video when we were talking about Wells Fargo Corporation and how they might be struggling with their dividend. The same thing goes for JP Morgan Chase. I think they're in a better financial position than Wells Fargo. I hate to admit it, but they have raised their dividend from 44 cents up to 90 cents, so a little over a double up. They have a 3.86% dividend yield, so about 4%. A lot of the big banks, I do worry with their dividend, with how much they're having issues with lending programs and the Fed restricting share buybacks and things like that. I do wonder if JP Morgan will be able to keep their dividend, and the same thing goes for JP Morgan, as I said with Wells Fargo. If they keep their dividend, I'll be owning it all the way through this recession. If they keep it for the next 5 years, I'll be owning Wells Fargo and JP Morgan for the next 5 years. JP Morgan is a company I love. They're the largest bank in the world. I know they're really close with a lot of other banks, but they are such a large, huge brand, and they have such a large footprint of the economy. I think they do have a pretty good chance of keeping that dividend as long as this shutdown doesn't last any longer. So JP Morgan, I'll be adding shares over the next month. The next stock is AT&T, another dividend aristocrat. With the market rising in the last few weeks, I think now AT&T actually is the highest yielding dividend stock in the portfolio with right about 7%. They've raised their dividend from 47 cents all the way up to 52 cents. They have slowed that growth down quite a bit, which I don't like. They did just suspend share buybacks, and the thing is, I don't really care about share buybacks. I would always rather have dividend raises over share buybacks anytime. I would rather that growth be organic or returned back to the shareholders. That's just me. The thing about AT&T is that their stock has pretty much stayed flat for about a decade. This is one of those things, it doesn't really matter because their yield is so higher. As long as they keep their dividend, I'm going to be a shareholder. With a 7% dividend yield, where I bought it at, I believe it was right around an 8% dividend yield, the equity that I'll be gaining in this company just for owning it, I honestly don't care. If this stock stays at $30 for the next decade, I'm going to be a buyer. As long as they hold that dividend, I'm in for it. They could reissue share buybacks. They could cancel them. I don't care. I want to see the dividend raised annually. They just raised it again this year, about 6 months ago, and hopefully they'll be raising it again next year. And if so, I'll be a buyer of AT&T, and I'll be looking to add more shares of that next month as well. The next stock in the portfolio is Verizon, its competitor to AT&T. I did just receive dividends on Friday from both of these companies, as you saw earlier. Verizon is a little bit more well run, and they don't have such a significant debt like AT&T does. They went from 55 cents a quarter in dividends up to 62. They have a 4.33% dividend yield. And Verizon is pretty much the same thing as AT&T, another telecommunications company that I think is very safe and will have a lot of demand even in this recession. So we'll be adding to that next month as well. Qualcomm did just raise their dividend. They're one of the first stocks in the portfolio to do that. They raised their dividend from 62 cents up to 65, and over the last 5 years it went from 48 cents up to 65 cents for this new quarter. They have a 3.44% dividend yield, and I think the potential here with 5G and Qualcomm has, with its partnerships with Apple and so many other potential partnerships it has with other factors of 5G, I think the share price gains here over the next 5-10 years, it's going to be stupid. It's going to be massive. It's going to be ridiculous. 10% over the next 5 years, it's going to be a joke. I think the stock will easily double over the next 5 years. So I'll definitely be adding more Qualcomm in the coming months. Dominion Energy is a similar play as the Southern Company. I like the Southern Company a little bit better, but the Southern Company, just like Dominion Energy, raises their dividend every single year. Dominion Energy has went from 65 cents 5 years ago up to 94. They have right about a 5% dividend yield, and this is another safe company that is very conservative investing. It's only went up 5% over the last 5 years, but with pretty substantial dividend growth. Once again, with electricity being in demand and other utilities always being needed, I think this is a company that I could see myself owning for a very, 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 very long time. And Altria Group is one of the worst performing stocks in the portfolio. We are about break even. Oh, so I was actually wrong. Altria Group is the highest yielding stock in this portfolio with 8.86%. Now, don't get me wrong, I am not a tobacco user. A lot of you that use tobacco know exactly what I'm talking about when they say how it is a very sticky customer business model. People who end up smoking, vaping, whatever, especially with cigarettes, end up smoking cigarettes usually for decades, if not an entire lifetime. So they have very sticky customers that are repeating those buys and those purchases for cigarettes and stuff like that. They have raised their dividend from 52 cents all the way up to 84 cents over the last 5 years. And even though I'm not a tobacco user, that dividend yield is just so high. This is a dividend aristocrat. This is a dividend yield that is so high with such substantial dividend growth, it's hard not to buy it. As long as that dividend keeps on getting raised and they don't cut that dividend, which I don't think they will be, I will definitely be an owner of the stock. So I'd like to thank you guys so much for watching. As usual, as I always mention at the beginning and end of my videos, if you like watching my videos and you're interested in using M1 Finance, use this link down below as in the description of all of my videos. We can each get $10 and I'll put that in my dividend portfolio and it can help get you started, and I'll make sure to mention you in the video. Those of you that watch until the end, I thank you guys so much. I love the watch time. Hopefully we can get this channel monetized in the coming few months. We have got quite a few subscribers and a lot of new viewers to the channel. So each month I will be giving an update to my portfolio every single month at the beginning of the month. And thank you guys so much for watching. Comment down below what you thought about the video and any questions you might have. Thank you guys so much for watching, and I'll see you next time.